So I'm reading a report that basically is telling us that the pause in home price declines that we've seen over the past couple of months, it's just temporary. Things are going to pick up again and they're going to start to decline the second half of this year for 2023. And we're almost already there. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy here putting the realism back to real estate. And today is June the 14th. The month is almost half over. Time does fly when you're having fun in real estate. All right, very interesting. This was in Fortune, and we'll go from there. The housing market is so detached from fundamentals and reality that a leading research firm predicts the pause in home price declines is about to prove temporary. So basically, people have already been talking about the fact that because we had a little bit of uptick in Case-Shiller in February and March, that, oh my gosh, we've already hit the bottom. Housing's going to start to recover. There's no more loss, no more bad things happening. Just, keep buying. Prices are going to go up, regardless whether we have affordability issues, high interest rates, low inventory, whatever you want to say is causing some problems. So interesting enough, so after falling for 7 straight months between July 2022 and January 2023, U.S. home prices measured by the seasonally adjusted Case-Shiller Home Price Index, as I said, rose in February and March of this year. However, a research firm predicted that U.S. home prices had not reached the bottom. Peak to trough, this group, which is called Capital Economics, expected home prices to fall 8%. Now, I've done a number of videos over the past few months, going back a few months, regarding the players that are in the industry talking about just how much they think home price values will decline. Some people think it's actually gonna go up 3 or 4%, 5 or 6%. Some are predicting like 8 to 10%, some 15 to 20. Some are saying some markets will be as high as 30 to 35%. So it's very metro specific. And then, we have to blend that across the board, obviously. So basically, they put a new report out. This is called Capital Economics, is the company. Pause in home price declines prove temporary. The report argues that following the resilient spring housing market, home price in the second half of the year will revert back into correction mode. So we're not out of the woods yet. So again, after falling 7 straight months, national home prices rose in February and March. You can see that's the Case-Shiller depiction there. We can see that we had some red at the right-hand side, and we have a couple of months of the light blue. So that's where we saw February and March. Realize that, of course, Case-Shiller runs 2 months behind. So here we are. When we hit the end of June, the last Tuesday in June, we'll be talking about April Case-Shiller statistics. So we're always a couple months behind and lagging with Case-Shiller. Now, basically, it recently ground to a halt with the Case-Shiller index. It's partly driven by the temporary boost to demand at the start of the year from declining mortgage rates. So yes, we are fickle, and the minute or the second there is a decline in mortgage rates because it's so expensive, people are taking the opportunity to lock in and put things under contract, etc., which does make sense. But rates have since returned close to the double-decade high set in October, which has caused demand to fall to its lowest level in almost 30 years. So if we take a look at sales activity. Sales activity on existing homes is so low, as I said, almost the lowest level in 30 years. Given this in a weakening economy, because that impacts everything that we do, we expect sales will remain low and that price growth will turn negative again later this year. So these are economists who are looking at the market saying, yeah, we're going to see negativity coming back in house values. So, of course, with the exception of CoreLogic and Zillow, because, of course, that group or those groups, their economic models, continue to project house declines in 2023. Well, sorry, with the exception, because most economic models continue to project house declines in 2023. Of course, when your real estate products and mortgage products are based on sales and more sales, and Zillow, when you have self-serving algorithm with their Zestimates, yeah, they want, values to go up because they need that to self-perpetuate. The underlying reason is the housing affordability, or better put, lack of affordability, has become strained at levels not seen since the housing bubble. So we're going back into 2006 when the housing bubble was peaking, and we haven't seen these levels of unaffordability for more than a decade. So there you go. So moving forward, here's the heat map, which is very interesting. Obviously, you can see that shift in county home prices since their respective pandemic peak. So the orangey, rusty color is, greater negative shift. Blue is basically zero, okay? Zero-ish or very slight increase. So we can see where the majority of the orange color tends to be in the West Coast locations. So we've got essentially, we're looking at, from what I see here, is Washington State, Oregon, California, Nevada, Idaho, New Mexico, Utah. Obviously, we've got parts of Colorado, New Mexico, Texas in the Southwest. We've got some stuff going on there. Moving away, into Louisiana. We got Mississippi, Arkansas, obviously over to Florida. You've got Georgia. You've got a little bit in the Carolinas. Obviously, stuff going on in Tennessee. And then we've got a little bit in, it looks like Kentucky, West Virginia. Obviously, New York a bit more. Looks like possibly Massachusetts area and Long Island. Funny enough, when we're going to the North and South Dakota, we're seeing decreases. And I don't know whether that's because of certain industries are leaving or not employing as many people. Obviously, Minnesota, we got some stuff. Funny enough, what we don't really see much of it is Illinois, obviously more the southern parts, but the Chicago area not so much. The reason being because they've already taken a hit over the years with respect to their loss in equity position. So it's interesting to see where the heat map kind of works or doesn't work, I guess, based on your perspective. But obviously, as they always say, the bigger they come, the harder they fall. So the higher the exponential, higher home price value increases over the past years, you're going to see the, we'll call it proportional or inversely proportional, depreciation or devaluing of those locations. It tends to always happen that way. So this will only get more orange or deeper orange as time goes on. So don't be surprised. So folks, if you enjoy the information I provide, if you could help my channel grow and hit the subscribe button, I'd really appreciate that. And if you're a current subscriber, could you just hit the subscribe button again, resubscribe, put the bell notification on, because I lose subscribers, of course, all the time, as I've been telling you guys the past couple of years. All right. So anyway, thank you very much. Appreciate you guys watching. All right. So the Fortune article in the heat map was derived from this. This is the actual, economic, I guess you could say, whatever the company was called that did this, Capital, et cetera, is whatever they're called. This is their report. If you want the report, send me an email. I'll send you the report. Okay. So obviously they're saying the pause in home price declines to prove temporary. Basically, housing boost demand start of the year from declining mortgage rates, but rates have since returned. So here we are. Given the weakening economy, we'll expect that it'll turn negative, which I mentioned. Now, funny enough, in the rental sector, prices are headed for even a larger correction. We expect apartment capital values will plunge a further 20% in 2023 and in 2024, resulting in a peak to trough fall of 25%. So apartments and larger rental accommodations, they're not part of the residential, I guess, the residential section of real estate. They're commercial. So when you see values plunging 20 and 25% on rental, multifamily units, etc., the issue is going to be for those who are having to refi in their commercial mortgages. That's going to cause some big havoc because, again, a lot of stuff going on in the commercial world that's not very good. So single-family weak mortgage applications point to further falls in existing home sales in the coming months. New home sales will continue to outperform as the tight inventory of existing homes pushes buyers into the new build sector. This will support home builder confidence and single-family starts. So yeah, now new homes are still way more expensive, but I guess people are going, you know what, we're not going to haggle with the issues that go along with respect to the existing home sales. Why not go to a builder? Builders are offering a lot of incentives. Builders are doing buy downs on mortgage rates, etc. So you can pick up some pretty nice homes for some good prices if the builder is willing to deal and they want to move their inventory. So there's no doubt about that. So this article or this report had a lot of charts. Obviously, this is the mortgage application for home purchases. We can see towards the right hand of the chart how those applications have been dropping pretty exponentially over the past year or so. So that's interesting to note. Again, their commentary: mortgage rates rose from an average of 6.5 in April to 6.7 in May. The weekly data showed rates 6.9 the past 2 weeks of last month, at the near 20-year highs reached in October of last year. So we're back up to the peak. This was partially driven by an increase in the 10-year Treasury yield, but also by a widening in the spread with the mortgage rate caused by a reduction in MBS demand following the recent bank collapses. So yeah, mortgage-backed security demands have been dropping. A lot of the banks that have collapsed are causing some problems for the government, the Treasury, the economy, etc. We all know that. High mortgage rates mean that affordability is still poor even after a small fall in house prices. So the amount of reductions we're seeing for homes in the marketplace isn't really enough to offset the increase in interest rates. So the problem is that people, home sellers, still really believe it's back in 2021, 2022. They're still trying to cash out and maximize, which, it makes sense. Of course, we all want to do that. Are they being given poor advice? Are there real estate agents telling them to list high and we can always drop it? But again, sometimes you go the opposite way. When you list high, you stay on market longer and you don't get showings. It actually hurts the eventual sale of your property. So very interesting. That's the way it goes. It's resulted in cash buyers accounting for a higher share of sales over the past couple of years, but their support hasn't been enough to lift activity in recent weeks. So essentially, the rise in mortgage rates led to a decline in mortgage applications for purchases to the lowest level in almost 30 years. This points to further declines in existing home sales in the coming months. So yeah, we all know that, as looking forward, mortgage applications for purchases pending, sales contracts, all lower, low, which means future sales will be affected negatively. We won't have as many, etc. This article has a lot of cool things here. Charts to look at. Mortgage, top left, mortgage payments as a percent of income. So obviously, mortgage payments as a percent of income is rising. Why does it rise? Because interest rates are up. Cash sales as a share of total season adjusted sales percentage, that's rising. Mortgage apps index, you can see for home purchases and refinance down low. Mortgage applications and existing home sales. So basically, mortgage applications for home purchase is dropping, and with that, of course, is existing home sales. So everything runs hand in hand. It all ties together very nicely. The fact of the matter is our market is slowing down significantly. New home sales have performed better than the existing ones, of course, recovering close to pre-pandemic levels, not only due to price reduction incentives offered by home builders, but also the shortage of existing homes. That's true. Higher costs of new mortgages have discouraged homeowners with low long-term fixed rates from moving. So as I've said before, we're kind of in what we call this rate lock situation. You're in a house, you'd like to maybe either upgrade or downsize, but your mortgage rate is so good that it would cost you equity and a much different monthly payment if you were to relocate. So in the end, is it worth it? So people are choosing to stay in their house because they don't believe that, or they've worked the numbers out saying that, hey, I'm either going to pay more or dip into my equity, which I didn't want to do, but my monthly is going to be too big and I don't want to play that game right now. So that's where that's what we're seeing. So of course, this pushes potential buyers into the new home building sector. So pickup in new home sales has supported a rise in home builder confidence and have helped stabilize the housing starts. So back a few months ago, there was a big discrepancy about 3 months worth of inventory in the existing home sales across the board nationally, but we had almost 11 months of inventory for new builders. So it'll be interesting to see how that plays out. I'll take a look at that next time we see the home starts and home builder reports from the Bureau of Labor and Statistics, which comes out on a monthly basis. All right. House prices rose for the second consecutive month in March. Expectations of future growth have turned positive. It could partly reflect the temporary boost to demand at the beginning of this year from declining mortgage rates, but rates again have gone up to their 20-year high, which will apply renewed downward pressure on prices. Therefore, as economic headwinds strengthen later this year, we think house price growth will turn negative again. So they're pretty consistent in the report here as to why we're going to have issues and why we're going to have negative home price growth. So we're losing, okay? Obviously, existing in new home sales. So new home sales are in the blue, top left, existing is in the black. So, it does pop here and there, but we can see that the blue is much higher on average. It's moving upward. And again, single family starts, home builder confidence. So obviously confidence rises when starts go up for the builders. Number of homes under construction, well, it's gone down a little bit, but again, a lot of it is clearing some backlog for sure. And then as things stabilize in the new home builds, they'll restart a much more aggressive construction phase if the buyers are there. Obviously, house prices, Case-Shiller and FHFA predictions or actuals, you can see that the past couple of months they went up a little bit instead of growing. House price growth expectations, well, you know what? Looks like the New York Fed and Fannie Mae seems to think it's going to grow a couple of points, but we'll see what happens as time goes on. All right. So it's interesting, but again, I want to point out here is that, like everything, everybody tries to control or create their own narrative. I do the same thing, right? My narrative is very obvious, right? And I've never deviated from that. I want to make clear people understand. I don't jump on the bandwagons. We were seeing house bubbling and issues 2018 and 19. COVID pandemic came in and basically put a stall to the market. We had an eviction and foreclosure moratorium put in place, which essentially choked the market from additional inventory and lower price inventory, which essentially caused price points by that choke and government control to rise exponentially, like big time over a short period of time. And that's where we are today. Now we're seeing some normalization. We're not back to where we were 2018 or 19. We're far from that. So we're not really pre-COVID with respect to values. I think we're working our way down. As I mentioned, specific metro markets will start to feel this. Well, they're already starting to feel this in locations across the country. More will take place as time goes on. So listen, we just did a deal. Okay, I've actually done a couple of deals. When I mean deals, like completed deals, like selling, closing, earning money. So a couple of weeks ago, did a short sale here, locally here. Was able to get a 40% discount off the mortgage. So for those that say, oh, lenders don't discount in this type of environment, well, you know what? They do, because that's what we do, and I have a great system. I know what I'm doing. So 40% discount off the mortgage balance. It made the property a nice deal for a purchaser. Just did a deal, closed literally yesterday. A large, huge, loan balance. We basically got a 50%, the reduction over or off a $2 million plus mortgage balance. So can do that. And I'm looking to close another property. Just a matter of getting the last little bit from the lender here. It's a property that we're going to be buying for $28,000. So yeah, I mean, all over the map with these properties, but someone's getting a really great deal on that property because we have a system, we know what's going on. So everything I talk about on this slide, we're involved with. We have the technology, the skill set, the experience, the players, etc. So if you'd like more information on my programs, I suggest you reach out to me. I partner with a lot of investor people, so I have large investors that essentially bring me deals to work on for them because they know that we have the ability to cut through all the red tape and get the stuff done for them. So people that do, like, they're not onesie twosies. They're multiple deals monthly, and they run pretty big operations. So that's what we do on our end. You might want to check out what I got. Send me an email. We can talk about programs. It's important because right now no one's doing this business, or very few people are. And if you have a certain skill set, that'll be very attractive for all sorts of people to utilize your skill set and pay you hopefully accordingly over the next couple of years. So that's what I got to say for today. So once again, everybody, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. You want to talk to me, reach out to me. We'll set up an appointment to talk, and I look forward to speaking with you before week's end. Take care.